This is Financially Fit Radio with Corey Sickles from Safe Harbor Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Corey provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Financially Fit Radio with Corey Sickles.
Hello and welcome back to Financially Fit Radio. My name is Corey Sickles from Safe Harbor Retirement Group and Wealth Advisors. If you'd like more information about what you hear on our show today, just give us a call at 614-760-0670 or visit us online at safeharboroh.com. And while you're on our website, click on that radio page. You can check out past shows and subscribe to our program on Apple Podcast, Amazon Music, Google Podcast, or Spotify. Also, feel free to visit our YouTube page by typing in Safe Harbor Retirement Group to watch videos on different financial topics. And please don't hesitate to reach out to us if you have questions or if you want to set up a face-to-face or virtual meeting. And remember, all meetings are complimentary with no obligation. Well, today, what I kind of want to focus on is really discussing strategies to protect your assets. You know, I think everyone's more worried about right now protecting assets rather than worrying about growth in the market. You know, we've been dealing with the debt ceiling. We've been dealing with inflation. We've been dealing with interest rates. A lot of negative things that actually has affected the stock market. But before we kind of dive into that topic, let me introduce to you my co-host this week and every week, and that's Tony Shore. Tony, how are you today?
I am doing great, Corey. Thanks for having me on the show, and I'm excited. It's the weather's been great. I've been enjoying the summer so far. How about you? What have you been up to?
You know, what have I been up to? Been really just meeting with clients. Had a little mini vacation, a little golf vacation. But, right now, here we are already June. It's hard to believe 6 months. I mean, we're in month 6. Time does fly.
It goes by so fast. And I know one thing that helps it go by faster is how busy you've been. And I'm glad you got to take a couple of days off to go golfing. Other than that, you've been busy meeting with clients. And I know that you have a lot of new people from the radio show. You love hearing from people and setting up consultations to get financial plans in place. But I've been busy as well. I've been helping my dad prepare for the auction. They're going to sell off all my he inherited my grandpa's farm, and they're selling off some of the old antique tractors and tools. They're having a live in-person auction with an auctioneer, and so there's a lot of heavy moving around that has to be done and organizing. Sure. So my son and I spent about a week down there. I took a few days off helping him over Memorial Day weekend, and that was a lot of fun, but a lot of work too. And I have allergies. I'm allergic to manual labor. I've told you that before.
I think a lot of people are. Right.
But it's good to get out there and do some things with your hands. Had to help my dad out. He would try to do it all himself, and he's 80 and not in good health. So had to go down there and help him out,
Oh, yeah. Well, I mean, your grandfather was what, 100?
101.
He was 101. Your dad's 80.
Yeah.
So you got good genes.
Yep, good genes. Yeah. And
you need to make sure you protect your assets, Tony.
Yes, I know. In fact, wow, what a segue, Corey. Yeah. I like it. I should have had the drum for that one. That was good. But yeah, that's what we're talking about today is protecting our assets. And, we do need to protect our money, especially if we know we're going to have a long life or think we're going to have, no one knows for sure, but I have longevity in my family. People are living longer and longer. So I need to make sure I'm protecting my assets. Where do you want to begin with this discussion? What can we do to make sure the money we've put away or invested all these years is protected?
Well, I think really the first thing to do, Tony, is everyone needs to kind of, assess where they are, in their life, right? Are you working? Are you, do you have 10 years for retirement, 20 years for retirement, 5 years, a year, or are you even retired? I think that's a big thing. And one of the things that, of course, that you'll do is as you near retirement or if you are retired, one of the things you're going to find out is your overall risk tolerance just becomes naturally more conservative. You're not so much worried about getting those 20 to 30% gains. You just don't want to have 20 and 30% losses, and you want to be able to protect, the assets that you have. And I really think the first thing that everyone needs to do is find out what their risk score is, right? And then make sure that you actually allocate based upon that risk score as well. So, for our listeners out there, if you go to our website at safeharboroh.com, we have a risk assessment that you can do. It's 11 questions. It's pretty quick. At the end of it, it's going to give you a score. And we're able then at that point to sit down with you and kind of, review your portfolio. What score do you have today? What is your risk? Are you allocated the correct way? And then we can show you on how to allocate to that risk score. And that's something that we do for our clients on an annual basis, because what happens naturally is, your score is going to more than likely become a little bit more conservative year after year.
Yeah, it tends to trend that way. I know I have become more conservative with my money as I've grown older, and I think that's true for most people, not all. But everybody is different. Everybody has their own risk tolerance, and that's why you have them answer these 11 questions. You talk to people, you get to know their situation, because that's really going to determine what they need to do and the decisions they will make about their money, right?
Yes, I mean that is the number one goal. I mean, once we start looking at doing an analysis of your current portfolio, then we're going to be able to say, here's what we kind of recommend. If you're a current client, then we might just reallocate within different portfolios that we have. But and the other big part of that is are you more interested in accumulation, or do you actually need to take some of this money that you do have saved for income, right? So you want a combination of income plus growth plus protection. So it can become kind of complicated, for what I would say is just for the regular individual out there, the regular investor, to try to do this, really to try to do this themselves.
Yeah. Yeah. And you don't need to go it alone. There's no reason to try to do that. You wouldn't try to perform surgery on yourself if you're not a doctor. And even if you are, you'd have someone else do it. And it's the same with your finances. You're too emotionally attached to your own money, right? That's what you've told me before, yeah. Corey. And then your decisions aren't always going to be the best. You might make some knee-jerk decisions or emotional decisions, not looking at the big picture. You need to work with a financial advisor who's not emotionally attached, who can look at it logically, do the math, look at your situation, and who has gone through this process with so many people. They know the pitfalls and know what to plan for. And that's where you're at. That's why people have to work with a financial advisor. I just think that is so important. And that's a big part of protecting your money, isn't it? Having a financial advisor on your team.
Yeah, I do think it's very wise to be able to do that. It's not so much, Tony, that we're, of course we're not emotionally involved when we make decisions, but that doesn't mean we don't care about what our clients, right?
I didn't want to make it sound like that. No, yeah.
I know, but what happens when you're emotionally attached to it because it's your money? You're going to be getting out of the market, back into the market. Are you doing it at the right time? Yeah. One of the things that we try to do as an advisor is, we want to make sure that you're allocated the correct way based upon your risk score, right? And there's different ways to be able to do that, but that allows us to take the emotion out of it, because if we have you allocated the correct way, you're going to be able to handle the ups and downs within the market and not have to try to time it. The worst thing that you can do is time the market, because who knows whether the market's going to go up or down tomorrow, and that's especially right now. So you can't time it. The only thing you can do is be in it for the long haul, which is really what we try to do for our clients.
Yeah, and in fact, wise people have said you can't. If you try to time the market, you'll lose every time. Or it's not timing the market; it's time in the market, as Warren Buffett, the Oracle of Omaha, always said. And he's one of the greatest investors of all time.
That's correct.
He's been doing it a long time. He knows it. And, everyone who tries to time the market that's basically gambling. That's Vegas. You might be up once in a while, but in the long run, you're going to lose. So nobody has that crystal ball, but there are ways to invest for growth. There are actively managed accounts. That's what financial advisors can help you with, and they can help you be in it for the long haul. But there's that risk tolerance, and some money is at risk. If you have it in the market, it's at risk, even if you're conservatively invested. So I imagine you have to have a balance. You can't have all your eggs in one basket, correct?
That's correct. That's correct, Tony. And really what I kind of want to talk about are, just some ways that we can actually work with clients in order to protect their assets, but also kind of get growth too. You want some upside, right. You do want some, protection. And of course, one of the easiest ways to do that right now, I mean, everyone that comes into my office goes, well, CDs are paying 4 or 5% or 3, 4, and 5%. That
sure.
That's one way to be able to do it. But with a lot of that, I mean, sometimes you're going to be able to only be able to guarantee that for maybe 1 year or two. Do you want to tie your money up for 2 to 3 years within a CD? We have what we call, MIGA. We do have MIGA annuities out there. They kind of do the same thing as a CD, but they're backed by an insurance company, not necessarily the FDIC.
Sure.
And of course, that's been in the news a lot. You're still protected up to $250,000 either way that you want to go. But MIGAs have good rates right now.
Yeah. They usually outperform. The rates are usually a little better than CDs. I mean, I know that in order to get that 3 or 4% from a CD right now, you're only going to get that for a short period of time.
That's correct.
And they have some MIGAs that have some pretty good terms, and that's safety, where your principal's protected, right?
Yep. It's pretty simple. If you got a 5% rate, you're going to make 5%, whether you keep it in there for 2, 3 years, 1 year, whatever that is.
Sure.
So that's you can't lose any money. There's no fees associated with MIGAs either. So you're just going to be able to make that percentage. Now, The nice part about it is there are some MIGAs out there where, say you're making 4.5%, 5%, but you can, on an annual basis, you can actually take the interest out penalty free as well. So if you're maybe looking for a little bit of income, your assets protected. Now you're able to take some money out. If you want it on an interest, if you want to take it out on an annual basis, or you can leave it in there and just get the growth as well. Everyone's situation's different.
Sure.
But, that's one way to be able to do it. And then, of course, the one thing that we've talked about on our shows as well, Tony, is now you're kind of stepping it up a little bit. But, we have fixed indexed annuities out there. Now, here's kind of one of the nice things about interest rates, right? We just talked about the MIGAs. When they raise interest rates, the MIGAs actually go up. Mm-hmm. The other part of all this, the participation rates, Tony, for fixed indexed annuities have gone up as well. If you go back and look, I'm just going to use this as an example. 5, 6, 7 years ago, you might have only had a 3 or 4% what we call an annual cap on the S&P 500, which means the most that you can make would be 4%. But right now, you're able to actually get anywhere from 8.5% to 12% with no risk, but you can still make that 8.5% to 12% depending on what the S&P does on an annual basis. So the nice part about that is you're making more money. You can't lose money in a fixed indexed annuity. There's a lot of fixed indexed annuities out there right now that have very good participation rates, different indexes. All that means to you, the consumer or the client, is that you can make more money when the market does well. Even the fixed side of that on some of these right now, Tony, are around anywhere from around 2.5% to about 4.6%. So if you want to just put money, a portion of your money in a fixed account, again, it's paying like CDs, as well as you can still have a nice percentage of your money invested in the market. But here's the key. There's some out there with zero fees. And when the market's negative, the worst you ever do is make zero.
Wow. So that's great. So even though you get to participate on some of the upside, you don't participate on the downside. So your principal's protected, right?
That's correct.
And that's by the claims paying ability of the issuing insurance company. And insurance companies also have insurance on that money. And I know that you work with A-rated companies as well, right?
That is correct.
Yeah.
We work with A-rated companies, and here's some other benefits of that. There's one company out there right now that gives you 11% bonus on your money.
Wow.
Right. So if you put $100,000 in, it's worth $111,000 tomorrow. There's a range of another company out there, or companies. The bonuses can go anywhere from what I would say right now from around, say, 5% all the way up to around 14%, Tony. So, again, that's a good way to be able to get instant, increase in your accumulation, better participation rates. Some of these have income riders. We've talked about income riders in the past, but the ones I'm really kind of focused on right now is accumulation, right? So this is a good way to be able to try to accumulate money with these type of products, just like you would with a CD. But in the long run, or during this 5 or 10 or 5, 7 or 10 year period that you have money in there, you're going to be able to, what I would think, hopefully, be able to make more money than you would within a CD, because you're getting that upside potentially off of what the market could do. That's the key, is we can't do any guarantees off of any of this, but it's what it could do. But at the end of the day, you could have great upside participation with no market risk with these type of products.
Yeah. Yeah, there you go. I think that's fantastic. And it's great to know that there are all these different options out there to protect your principal, to protect some of your money. You don't want to have it all at risk. And these are great options. And I think a lot of people don't understand. There are a lot of misunderstandings about some of these vehicles, about how CDs work, about how MIGAs work, about how fixed index annuities work. And I know as an independent financial advisor, you're not just trying to push stock investments. You're not just trying to push insurance products. You're looking at all the options to find what's going to fit your client's best interest and be the best for them.
That is correct. Great. That is correct, Tony. And just like we just talked about, the annuity side of it, you have some better, another option is maybe you just want to put it into maybe like life insurance, right? There's some products out there that can, build cash. There's definitely some out there that can build cash. You can maybe eventually later on in life take it tax-free. There's some out there where you can just put it in, and there's some out there have return of principal. So, you put $100,000 down, you have good participation rates like we talked about. If you need the cash back, you can pull it back, or you can just let it accumulate over time as well. And the nice part about paying that lump sum, is you don't pay any capital gains or any type of taxes on it until you actually take the withdrawal from it.
Sure. Which
could be 5, 6, 10 years, 20 years later, or maybe you never do that, and now you have a death benefit that goes tax-free to your beneficiaries. So the nice part about a lot of these products, again, you only get the upside protection, or, you only get the upside participation. The market's negative. The worst you ever do is make zero. So when we start talking about fixed indexed annuities, MIGAs, as well as, indexed life insurance, we always say, zero's our hero, right?
Right.
And what we mean by that is when the market's negative, the worst you'll ever do is make zero on some of these type of products.
Great show so far today. We're talking about protecting our asset. And really, you love to sit down with people, see where they're at and what they have, and say, hey, you might want to take this and start a Roth IRA for that tax-free bucket, or you might want to do this. But you have to look at taxes play a part in protecting your money too, I would assume, because that can eat up a big chunk of people's money in retirement, and they might not know it, correct?
That's exactly right. We just talked, for the first part, really about being able to just protect, from an investment standpoint.
Sure.
But when we start talking about protection, we really want to kind of protect it from the IRS too, right?
Right.
I mean, that's a big part of it. And, one of the things that an annuity or a MIGA can do for you is it can delay when you're actually going to be able to pay those taxes. And if, of course, we talked about in the past, and we talked about briefly, even during today's show, there's also a way to be able to protect it potentially where you can put it into life insurance, and it works just like a Roth, where if we set it up the correct way, when you start taking money out of that, it's tax free as well.
Sure.
So there's so many of our clients, Tony, that have so much money in their IRAs and not, so everything is going to be taxed, but you want to be diverse to be able to protect your assets from taxes, because are they going to go up or go down here from this point forward, Tony?
They're going to go up. Probably way up, right?
Yeah, and we've talked so many times on the show. A lot of people think I'm going to be in a lower tax bracket when I retire. And 8 out of 10 of my clients, or 7 out of 10 of my clients, are probably in the same tax bracket they were in when they were working. So,
true.
Everyone's situation is different, but my point of it is don't think necessarily just because you retire you're going to be in a lower tax bracket. And there's only one direction taxes can go up, or there's only one direction taxes can go, Tony, and that is up.
Yep.
Long term.
Yep.
So, the last thing I kind of want to just kind of briefly talk about too is, we talked about annuities, life insurance, we talked about MIGAs, but we also have what we call our buffered products here, or our buffered portfolios, which is still invested in the market too, Tony. And, we have a buffered index, right? Our buffered index portfolio is a structured note that we actually do on a monthly basis, with the help of Gradient Investments. And it's pretty simple. I'm going to kind of just read one off right now for our June. This is what we have to offer for June. We have a structured note with RBC Capital Markets. The index is based upon the lesser performing of the S&P or the Dow. So you keep it in there for 18 months. Whichever performs worse, the Dow Jones or the S&P 100 is how it actually pays out. It has a participation rate right now of 100%, but you have at least a cap of 15%, Tony. But here's the kicker: the buffer has 100% protection. So let's just say 18 months from now, if the Dow goes up 10% and the S&P goes up 12%, you're going to make 10 because that's the lesser of the two. But here's the other kicker of it: if the market actually goes negative, then you're not going to actually lose any type of money besides the fee that you pay us, which is we charge a standard 1% fee to our clients. But you can't lose any money if the market goes negative.
That's amazing.
So it's a great way to be able to invest in the market, have upside participation, but downside protection.
Wow. That's
so hopefully I explained that well enough. A lot of people go, I don't know how they actually do that. We can kind of get into the details when you come in and meet with us about that. But that's a great way to be able to invest in the market, have protection. The only thing that you can lose is really at this point is the fee, or of course if something would happen to the underwriter. But that's really it.
That's awesome. That's a great product. So I think our listeners, if they have questions about that, can give you a call. Corey, one more time before we go, what's that phone number and web address?
Our phone number, again, here is 614-760-0670. And you can always visit us online at safeharboroh.com. You can schedule a complimentary no-obligation meeting with us. Again, we're here to help, really help you. And the best way to be able to do that is to schedule a complimentary no-obligation meeting. We can review what you have. And more than the most important part is really give you our advice on how we can help you and help your overall financial plan.
All right. That sounds great, Corey. Listeners, that does it for today's episode of Financially Fit Radio with Corey Sickles.
Join us again soon for another episode of Financially Fit Radio.
Thank you for listening to Financially Fit Radio. Don't pay too much for taxes or retire without a sound income plan. For more information, contact Corey Sickles at Safe Harbor Retirement Group.
Call 614-760-0670 or visit their website at financiallyfitoh.com. Corey Sickles and Safe Harbor Retirement Group are not affiliated with or endorsed by the Social Security Administration or any other government agency. All matters discussed during this show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation.